Is this historic move in gold a warning signal to equities? My name is Mike Rykse. I am the lead options instructor for NetPicks. And in today's video, I'm going to walk you through why it's important to set that narrative aside and focus on how you can take advantage as a trader to this move in the metals. If we take a look at the daily chart of GLD, this is the gold ETF. You can see the latest run to the upside, going back to August, it has been one for the record books. It has been a massive move to the upside. If I zoom out even further, you can see that GLD has been moving higher all year long. And oftentimes when you see this type of action in the gold market, it's a warning signal, right? It can be interpreted as people going to gold as a safe haven out of fear of potential moves to the downside in equities, a potential bear market. I'm seeing headlines that this move in gold is in reaction to what the Fed is doing. There's going to be so many narratives here over the next handful of sessions, really going into next week, where everybody's going to try to interpret and have their opinion on what's going to happen next. What I'm going to encourage you to do is to focus strictly on price. For us as traders, I'm not trying to predict what's going to happen 6 months from now. I'm looking at it saying, hey, if the Fed moves with interest rates, if we see a turn in the economy, if equities start to roll over, could that impact GLD? Sure. I'm concerned with what's going to happen over the next few days. Right? Can we potentially take advantage of this move that we're seeing? Right? And if I move this from the daily chart, now let's go over to the 130-minute time frame. This is the time frame that I use to drive my entry and exit decisions. It's okay to look at the daily chart to put the big picture context in place, but to actually make trading decisions, I'm doing that off of the 130-minute time frame. Is it too late to put on new bullish positions in gold? Sure. Be very cautious here at these levels, right? You're chasing a historic extreme. I'm not saying gold can't move higher going forward, but in the near term, we're very, very overdone. How do I quantify that? Is that just my opinion? It's not. If I take a look at this 130-minute time frame, and let's go ahead and zoom in a little bit so we can see it. Down at the bottom, you'll see we've got this red, yellow, green, and blue histogram. It's what we call our pulse indicator. If I take a look at the past 5 bars on the pulse, you can see that 3 of them have popped up as yellow. Price in the near term is between a 1 and a 2 standard deviation move. When that happens, the indicator pops up yellow. What that means is less than 13.6% of all occurrences fall outside of that range on the upside. Doesn't mean it can't happen. It just means it's not statistically probable. When you get this type of a pattern and this type of extreme, in many cases, it will lead to either a period of consolidation or a reversal in the other direction, in this case to the downside. Again, I am not trying to convince you that the top is in on gold. We could move higher in the months ahead. Remember, I'm only looking for a pullback in the very near term. Potentially a short-term reset where we work off some of the extremes, right? And let's take a look. Does that mean I'm going to buy a long put option? It does not. I'm going to take a look at selling a call credit spread. The problem with buying a long put out of this pattern is when you buy a long option, you have one way of making money. You need the stock, in this case, to move to the downside with a long put, and it's got to do so quickly. I want a more forgiving trade where I'm going to tie up less capital and give myself 5 ways of making money on the position. Here's what that looks like. Notice how price is also starting to break down below the 5-period EMA. We're starting to see some convincing movement here on the downside. You're seeing some profit taking. You're seeing a little bit of a move to the exit out of the bulls that have played this move to the upside over the past few weeks. Makes perfect sense. Let's jump over to the trade page and let's piece this trade together. So on GLD, we have all these different expiration cycles available to us. We have weekly options. We have monthly options. I'm going to go out to the November 7 options. Those are the ones with 21 days left to expiration. The nice part about GLD is there's a lot of volatility being pumped into the options. This is a historic move. We have not seen anything like this in a long, long time on gold. As a result, the market makers are pumping up the volatility. These options are expensive. That's to our benefit by using a credit spread. If I come in and take a look at the 398-400 call credit spread, all that means is I'm selling the 398 call and I'm buying the 400 call at the same time. Down at the bottom, you can see it's trading for 65 cents. In this case, I would be collecting $65 per spread, risking $135 per spread. That's my max risk on the trade. I like to be in that risk 2 or 3 to make 1 range with my credit spreads. So now I'm not tying up a ton of capital. If I come in, let me X out of this a moment. If I were to come in and just buy a put option, you can see over here on the right-hand side, you're potentially talking about $1,000 or more just to come in and buy a long put. They're expensive. The volatility is very elevated in those options. But because we're using a credit spread, I lower that cost. Let me bump it back up to 65 cents where it was a moment ago. I lower my cost of the trade down to $135. That's my max risk on the trade. Can you trade multiple spreads? Sure. You could take this trade with 10 spreads and still have $1,300 of risk. Very reasonable regardless of account size. You can trade 1 contract, 10 contracts, 20 contracts. Very reasonable here with the credit spread. And the best part about this trade is I have 5 ways of making money. Instead of solely being focused on the downside with a long put, I make money on this trade if the stock moves up, down, or sideways, as long as price stays below 398. I also make money from time decay adding up and from volatility decreasing. Any combination of those 5 will work out for me. Move to the downside, great. If we don't see a big move lower, what if we just sit here and consolidate and just chop sideways for a stretch? That's fine too, because the time decay will add up in my favor. And if things start to settle down a little bit and we do settle into chop, what if the volatility decreases? That would hurt a long option. It would help me with the credit spread. All right. Now in this case, the 65 cents is my max profit potential. I'm actually going to target 50% of that max profit. I'm going to take my 65-cent credit. I'm going to divide it in half. I'm going to look to buy this one back over the next few days for 32 cents. That way I can book the quick profit, free up the capital, and move on to the next trade. So in this case, I'd be looking for right around a 32, 33 cent profit on the trade. That would be a $33 profit on the spread. If I booked a $33 profit on the spread, that would give me right around a 24% return on my capital. Fully risk-defined trade. It's not riskier. A lot of times people get intimidated by the credit spreads because I think it's far more risk. It's more aggressive. It's not. It's actually a safer trade. It's still fully risk-defined. And if I can book a 24, 25% return on my capital in a few days with a fully risk-defined trade that has 5 ways of making money on the position, I love that type of trade. These are the types of trades that I'm looking for on a regular basis. I'm not opposed to buying long calls and long puts. We do it all the time. But adding in the credit spreads just gives you more flexibility. It allows you to make money in a wider range of market conditions. These are the types of trades that we take with our members all the time. Now, we would love to have you join us here next week. Coming up on October 21st, we are actually going to be doing a live webinar where I'm going to walk through a lot of these types of trades. We're going to walk you through in more detail what goes into the setups. How do we utilize the indicators? What does a winner look like? What does a loser look like? And best of all, you're going to be able to see that in real time on a wide range of markets. So all you need to do, click on the link in the description of the video. We'd love to have you join us live. Again, we'll be live on the 21st of October at 12 p.m. Eastern. So go ahead and get your spot reserved, and we'd love to see you here next week. So if you have any questions on the GLD position, and actually before I wrap it up, let's just talk about the stop price as well. That way you can see both sides of it. Our max risk is $135 per spread. If we take 70% of that level, I'd want to get out if the spread is down $94 per spread. We like to use a 70% stop on the spread, but that's not my actual stop price. If I want to get out when the spread is down $94, I also need to add in the 65 credit that I'm collecting to open up the position, right? So if I add that in, it leaves my stop price at $1.59. If I get out with at $1.59, it doesn't leave me with a losing position, but it only leaves me with a loss of 70% of that max risk. All right, so again, a lot to like about the GLD position. It's a historic move, guys. The opportunities are there. You don't want to pass on it right now. I mean, I think GLD for the next handful of weeks is going to be an area that you'll really want to have some exposure in. So if you have any questions on the GLD position, feel free to leave a comment on the video, or you can email us info@netpicks.com. We'd happy to help there as well. All right, I'm going to wrap this video up here. We'll be back with you guys over the next few days with our next video.
Everything discussed here is our opinion, and it is not to be taken as investment advice because we are not your financial advisor, nor have we considered your personal situation as your fiduciary. This presentation is for your education and entertainment only. Please review NetPicks' full risk disclaimer and privacy policy.